This right here is an RSI divergence. It's a bearish divergence because the price is reaching higher highs, but the RSI is reaching lower lows. I often use the RSI to complement my stock charts reading. Here's why. The RSI, or Relative Strength Index, is a momentum indicator used in technical analysis. It measures the speed and magnitude of a security's recent price changes. It was introduced in 1978 by Wells Wilder Jr., and it's used to evaluate whether a security is in overvalued or undervalued conditions. It's displayed as a line graph on a scale of 0 to 100. If the RSI line is above 70, it means that the security is overbought, and that means that the price is expected to decrease. And if the RSI is at 30 or below, it means that it's in an oversold condition, meaning that the security would be expected to correct to the upside. The RSI line crossing below the oversold line or above the overbought line is often seen as a signal for traders to either buy or sell. But it can be confusing because the RSI can stay overbought for extended periods of time if the stock's in an uptrend. It could also stay in oversold territory for long periods of time if the stock is in a downtrend. Like and follow for more tips.